Good morning, everyone, and welcome to Decipher with Deserve. This is very, very exciting next 60 minutes lined up for you, where we dive into what can happen to the Indian IT services space, not only from a stock price perspective or investing perspective, but also from a larger industry perspective and employment perspective. Very, very happy, privileged, and feels a lot of joy to have Trideep join us as a part of this fireside chat. Again, I've known Trideep for a long time now. Without disclosing his age, Trideep is one of the very, very few people on our street who has actually seen the dot-com boom and bust cycle. Trideep was actually one of the foremost IT analysts working with Kotak and UBS during the 2000 to 2007 cycle of the last, you could call IT services disruption, that we are being faced with today. No one, nothing is better than learned wisdom. So that's why very, very happy to have Trideep. Trideep currently is the CIO of Edelweiss Mutual Fund, manages a large team and a large AUM. Welcome to Decipher with Deserve, Trideep.
Thanks, Krishna. It's fascinating to be here discussing a very pertinent theme with you and your clients.
Thank you. Let's get started. Can we have the next slide, please? So start with what all of you must be reading. We just, if you were to put out a newspaper obituary about IT in Indian IT industry, this is what it looks like, right? Like the headlines is replete with with the demise of the IT services industry. Sometimes it's hyperbole, sometimes they have some numbers. But the thing that catches everyone's attention is that this is one of the largest employers in India, largest source of forex, almost close to $300 billion of foreign exchange. And we believe that this is the end. So this is the backdrop for why we decided to do this. We thought that, as with most things in investing and in our markets, we underestimate the long term and overestimate the present. This is just a very quick snapshot of all the bad news that you may have read. Next slide, please. So, before we get to the pen, we thought it is very, very important to, first of all, understand what is AI, right? And how is it different? So a very quick slide, AI, Gen AI actually started from this paper called All You Need Is Attention, written by Google Labs. And, I'll spend 60 seconds on this. So what is a GPT, right? It's a trained transformer model. So what happens is earlier, the way the stack of AI used to work is there was almost a rule-based engine, right? Saying that if, for example, if traffic signal is green, you go ahead. If a traffic signal is red, you stop, right? What this paper led to and what we are today after nearly 9 years of the paper being released by Google is they said you don't need to put finite rules, right? So what they said is, what you could have is attention. And if you have enough attention, you could infer the logic of what is being spoken about. So very simply put, what is the input text? How do I tokenize it? And then where do you let the word that you're looking for seek attention on itself? And that leads to output. I'm just simplifying it, but effectively what happened was, the word surrounding the query that you had, if you have enough of that in context, you could lead to an output. Just from how this became very big, obviously computing helped, but what led to was the internet, right? We have a large source of data available on the World Wide Web, and as you can see, the number of parameters that were getting used were upwards of 45 TB, right? So that's broadly what Gen AI is as of today. We have seen this evolve significantly. Just for context, AI as a term was introduced in the 1960s, but Gen AI is a phenomena that we saw play out in the last 9 years. And ChatGPT about 3-4 years ago is when it became a household name. Great. Now moving to Trideep and next slide, please. Moving to Trideep and something that Trideep you have seen very, very closely most of us, have not been practitioners when this happened while we were witness to it, but you saw it very closely. So if you can tell us how was 2000, right? Like, you entered the industry right in the middle of the boom, rode the way down, and the fall was as severe. So would love for you to spend some time on how it felt then. Does it feel similar now?
Absolutely. I think, first of all, your 60-second introduction on AI shows how well you understand, which is good to hear. But, I remember I started my career in 1999. And the first thing that I heard was a boom in IT services, and we call that Y2K boom, if you recall. Um, and tons of engineers would go on site, get the work done, and then return back, and that return led to a massive boom for Indian IT services companies, leading on to 99 2000. But then by the time we got to my second year in the industry, and think about a fresher in his second year, um, we learned that, well, after this gets done in the form of Y2K, who will need IT services engineers? Clearly, the number of headcount would go down, and we don't need as many people because the problem isn't there anymore. It's normal IT, right? And we all sat and wondered that technically, by virtue of linear thinking, that is very true. And as you said rightly, that we overestimate what can happen near term. Similar sort of headlines actually surfaced around that time that post Y2K, one of the severe job engines for Indian economy would go away and we will get into trouble. Well, we also were all of us, we were a tech analyst, and we all were thinking that maybe we have to look for alternate jobs. But what happened instead was that from Y2K, we latched on to what we call as the package implementation boom. SAP, Oracle, all of these packages started coming to the forefront. And for the first time, they needed tons of software or IT services engineers who could actually kind of, make that align with the organization's data and tailor make that with regards to how the organization is structured. And both the pricing of these services along with the headcount actually went up rather than down to all of our surprise in a matter of 2 to 3 years. Of course, 99 2000 was also a boom and bust time frame. So we went through the economic bust as well. But if I take the tech angle out of this and then kind of put it in front of you from IT services perspective, then came the package implementation boom. That ran itself for 3 or 4 years. And after that, there came the question that, well, software will now be sold as a service. And again, the doomsday scenario kind of picture happened that who will need IT services if software is sold as a service? It can do on its own. Um, it didn't work out that way. It actually needed more services engineers who could work with multitude of different scenarios in different organizations to sort of make it happen that way. Then came cloud and cloud infrastructure. And then what that meant is if the number of servers contracted to a few servers in the cloud, then you don't need as many IT services people, right? The IT work will shrink. And another doomsday prediction came about that, well, IT services days are over. Guess what? We not only survived that, we actually thrived because the number of headcount on the IT services went up because another trend came about at that point in time, which was more infrastructure services. So, in front of you, as I was regressing in my head, I could recount about 4 or 5 major tech cycles, and there were many mini tech cycles in between overall. And in that context, now we are dealing with AI. Uh, and again, the same sort of headlines resonate, saying that the IT services will not be needed. But one thing that I've learned over my close to 25 years of being a tech observer, maybe is a good way to put it, that in many ways we are like the barbers. And these different tech cycles are like hairstyles. So the hairstyles come and go, but the barbers always have a job. But don't underestimate the transition. Every time we move from Y2K to package implementation, software engineers and the industry had to evolve the skill set from doing pure simple coding to knowledge on these packages. Likewise, when we sort of moved from package implementation to software as a service, a new skill was needed. And the IT services industry evolved its skill set to adapt to the new one. There was a time frame of about 1.5 years where there was deflation of historical revenues and escalation of the new set of revenues. So my sense is, if you look at it, AI in that context, one would realize that this is not new. Every 3 to 5 years, tech cycles come and go, and so far, at least the tech cycle or IT services industry has evolved.
I think when we this is amazing, Sudeep, because very few of us can peel the onion that there were actually four cycles within the last 25 years and not one cycle. Most of us only remember the Y2K or the dot-com bust, but you're absolutely right. We went through application, we went through SaaS, we went through cloud. I mean, the Indian IT has been through a lot over the last 25 years, and the fact that we are a barber and someone will always want a haircut is quite interesting way to think about it. The one thing that still concerns, or is something that we are not able to wish away, is the speed, right? So in the next slide, what we have done is shown the speed of AI adoption, and that is something that probably unnerves, right? And when you couple this up with Twitter, LinkedIn, and Instagram, the echo chamber of the same story becomes so massive that it becomes very difficult for not only for people, for our client, but also for me to believe that AI will not change the world. So just for everyone's perspective, this is Mr. Nandan presented this beautiful chart in the Investors Day, where AI is the fastest tech innovation to reach 1 billion users, right? It's taken internet 13 years, it took smartphones 7 years, but it's taken AI only 3 years. And Tridib, you think that this is one of the few technologies where the adoption has actually been more consumer than enterprise and very, very fast. And is that leading to more nervousness among all of us?
I think the nervousness is actually self-led, to be very brutally honest. And I'll come to that in a bit. But speed of everything. So if I were to draw a parallel between what you showcased as tech cycles and the adoption to 1 billion to stock markets, I would say that earlier the boom and bust. If you look at 2000, the bust was almost there for 2 years. If you look at 2008, we took about a year and a half to come out of that. 2008, 2009, and 2009 middle when the market bottomed out. But I'll bring all of your customers' mind and attention to what happened in COVID. Uh, the world shut down, if I recall correctly, around about on March 23rd, and the markets bottom around March 27th or April first week. So in a matter of a week, the entire sort of impact was actually crunched. And this is the way we are headed, and partly driven by technology, partly driven by social media. We are seeing timelines being crunched in such a way. And clearly, that what that means is the companies have to adapt or adopt to new technologies far sooner than what they have to. This is the challenge for IT services companies to do that. That now they don't have a couple of years to get the skill sets aligned to the new cycle. They have to do that in a matter of quarters than otherwise. What is scaring the people, if you really honestly ask me and put hand to heart, is that AI is not just one particular segment. What we find in every department, whether it is finance, whether it is marketing, whether it is IT, the the deflation that it brings about, what it can do without the need of a human, is there, and we all identify and understand that. And that brings a bit of insecurity that if it were to take some part of my job, how will it happen? And I think that brings on to the moot question that, you have to look at past innovation cycles and to understand how humans have sort of managed that through. But that's the source of nervousness, I would say, Shushmit, as you rightly pointed out, the speed, the fact that it impacts all of us. And thirdly, how what you call how much B2C it is as opposed to just B2B.
Yeah, I think Tradep, you make a great point there. It's not the impact of tech innovation is very different in different cycles, right? Some impact B2C much faster than B2B, but we use it the same brush to paint the canvas. Tradep, to take a step back, and this is something that you alluded towards in your cycle illustration, which is what do IT services company really do, right? It's very easy for us to think that all they do is coding, right? Or some form of coding. So the next section, I want to kick it off with, in a way, you almost pre-read this slide, the next slide. So I think, it's for you, Pradeep, just to explain how, if we were to make this table 20 years ago, how it would have looked. And this is the reality today. And, when you, let's say, in your first analyst report back in 1999 or 2000, if you were to make what do IT services company actually do, how it would have looked and how it is today. And I think that will give all of us
Very interesting question.
a very good
So
perspective. Yeah.
if I were to look at the same split, we used to call it, there are two types of split: horizontal split, which gives you what you do in terms of services, and vertical split, which gives you in terms of industries you cater to. The industries that you cater to have not gone through a drastic change. Financial services was one of the largest industries, along with healthcare, retail, and a few others. That has by and large remained the same. But what has drastically changed is the horizontal level classification. If I were to go back in 2000, 2002, what you read as application development and management, or application development and maintenance, if I were to rephrase it, that would be close to 60% of the revenue. And there was hardly any infrastructure, there was hardly any BPO. Consulting was non-existent. Testing was the rest, about 25 odd percent, and then all the rest of it. What happened is, in the between 2002 to 2005, what you see in the form of infrastructure and BPO, that got replaced by package implementation revenues, and we used to monitor quarter after quarter how sort of package implementation revenues are growing, because that was a source of higher bill rates, higher margins, and all the good things that come along with it. Then came the BPO services. BPO services for some companies went as high as about 25 to 30% at their peak before coming down over a period of time. Consulting was practically zero till the time we kind of went into 2004, 2005. That's when consulting started to grow, and gradually it is now reached to levels where it is. I think the testing, which earlier used to be 25-30%, has now deflated to about 10%. Now, if you take a step back and play in your mind what I just said, you will realize that these service lines have gone through a massive overhaul over the period of last 25 years. What used to be 60% or more application development and maintenance is now 35%. What used to be about 20-25% or probably more testing and QA is now only about 10%. And the rest of them were not there at all about 20 years ago. And this actually brings to bear the point that I made in a verbal fashion in front of you, or in front of all your viewers, very clearly how the IT services industry has actually evolved over time. And that's to my point, which I made earlier, that they've had to sort of reinvent themselves, reskill themselves, retool themselves, and come back to still deliver what the client needed every 3 to 5 years.
This, I think, sometimes we, this actually reminds me of a very interesting book I'd read on, world GDP growth, right? We are so fascinated by figuring out which part of the GDP will grow that we forget that the world GDP has grown at 4% for the last 75 years, right? And, probably that is the parallel that I can draw, which is, IT services companies have grown at 12 to 14% top line over the last 25 years. What within them changes is, almost impossible to predict because the technology waves are such. Uh, so, thank you, Sudeep, for highlighting this. Um, the next slide is a very interesting slide that we kind of believe the positive of it, right? Can this play out? right? Today, we believe that the only people who can derive value from AI are the semicon companies and the hyperscalers, as we call them. Right? Semicon, we all know, Nvidia is the poster boy here, and hyperscalers, whether it is Google, Amazon, or Microsoft, they are the hyperscalers. But Sudeep, do you think at some point in time, right, this AI spend has the potential to go into the IT services layer or trickle down to the IT services layer?
You almost nailed it, man. So, think about in any business, the way you build up Deserve, the way we build up any business. First, you need the building. You need a place for people, or you need the systems, the infrastructure, the laptops for people to come sit and work. That, in my opinion, is basically the hardware, the semiconductors, and basically the bricks and the mortars of any organization, of any new trend. And to that extent, don't I mean I'm sure since we are discussing AI, everybody knows that this is probably one of the biggest trends since computers that has kind of come to go. So from that perspective, the world at the moment is building the basic layer on which the entire AI stack, if I may call it that way, will actually last over the next 30, 40, 50 years. So, hence, at the moment, the stock markets, the valuations of the poster boys of semiconductors are really at the forefront. But if you look at the investments that have gone into semis, they are now reaching as a percentage of GDP 8 to 9%, which is similar to what we saw during dot-com timeframe, where people invested in a similar way getting the internet up and running. Remember, when the first time internet came into being, it needed a lot of plumbing. It needed a lot of servers to be set on a worldwide basis. So this is www became one of the most sought after domains that one could sort of actually think about. Something similar is happening with regards to AI, and semiconductor is the first leg of it. Now, this is where, and hence, and because IT services don't play any role in this, we are in many ways, India is seen as an anti AI trade, and we've actually been a laggard as a market over the last couple of years. But what people forget is once you set the base, after that comes, as you rightly put it out here, the application layer and then the stitching layer. I think the stitching layer is very important for all of us to understand that AI can't just read anything and everything. It needs to make it, someone needs to make it talk to the individual or talk to the company that it gets invested. And that is where my suspicion is that IT services will have to sort of chip in to sort of, make a difference or will add to this. Uh, how the market TAM, as they call it, the total addressable market, which at the moment more hardware oriented, but as time progresses, it becomes more IT services, software oriented, like it has happened in multiple tech cycles. My sense is this will also evolve directionally. What you put out in this trade is the way that the overall the direction AI will go. We just have to wait it out for our time, and in the meantime, develop the skill set, which is the key ask. If I were to look at beyond just being a tech observer for the entire industry, develop that skill set which will be needed to capitalize on this AI cycle that we have in front of us.
In fact, Trideep, this is very interesting. Maybe you could also help our listeners and viewers understand how did this play out in the .com or the SaaS era, right? I still remember when SaaS came out and internet had become omnipresent. We all wrote the tombstone for our Indian IT services company again because somebody sitting in Valley could make a very simple software could make a simple software and that anybody could download it across the world. You didn't need Infosys and TCS, but and I somehow think we are kind of going through the same narrative when it comes to AI, saying that we don't need anyone. This can code in itself, right? Uh, and if you can give us an example either from the .com, which is once the internet came, everybody thought that once I have www dot, for example, deserve.com, I don't need anybody else for anything.
Yeah. So I think at that time, the majority of the retail as a sector used to be one of the very important clients of IT services companies. And people thought that if e-commerce is the way to go, if or www.deserve.com, if I have a domain and I have a site and I can sell everything, why the hell do I need so much of footprint, the physical footprint? And it can all happen in one go from my website and through a backend layer. We don't need any more infrastructure, so to speak. But what turned out to be is the moment they put up a website, the website got hacked. Secondly, when you have a website, when the commerce part grows on top of it, there are multiple levels of security, and at the same time, making it user friendliness also needed. These specific services were earlier not thought about, and and hence were missing from people's calculation. Going back to the example that I gave earlier, that if you look at horizontals, the names changed, and there were new areas that evolved which were earlier not there. So basically, what I'm saying is, yeah. So maybe you don't need as much of physical footprint, but you needed more IT services professionals to kind of take care of the user friendliness, the analytics behind the traffic that came onto the site, the plumbing that was needed on the back end to make it up and running when the volume of transaction increases, and the likes of it. So net, on one side there was deflation, but on the other side there was massive new markets which opened up. And overall, what we found is that the markets that have opened up turned out to be far bigger than the markets that went down. Though in the near term, given that we know the markets that will go down, the focus is always on what's going down. What people don't anticipate is the bigger parts of the market that may open up over a period of time.
Fascinating. This is extremely useful, especially in the historical context, because we've seen this play out. Uh, just going on to one more very interesting expert's view. And Trideep, again, for our viewers and listeners, this is from the Gartner's study, and where they actually believe that the total spend from IT services will actually rise from 26.6% in 2018, 28.9% in 2022 to actually 32.5%. And very interestingly, almost singing to the tune of what you were saying, that the spend on data centers will actually flatten out, which is the infrastructure. Once it gets rolled out, it gets rolled out. Uh, Firstly, Trideep, in your experience of the last 25 years, uh, should we even believe what Gartner says? Number one, and number two, how do we make sense of what they have put out?
Directionally, yes, the numbers will vary. And I think generally, when we have a disruptive trend, what my experience suggests is that the numbers could actually turn out to be materially different from what it is. But it usually moves in the direction as predicted, but far bigger, far bigger scale. So no one amongst us thought package implementation could be that big a deal. No one thought overall cloud will turn out to be as big a deal. There is some rumblings that AI is certainly a very big deal. How big is it going to be is not yet clear, but directionally speaking, it makes sense, and it makes logical sense that why once the data centers, once all of these, when the plumbing work is done, you don't need plumbing except for maintenance on a day-on-day basis. What you need to make sit is on top of all of this hardware, the advanced LLMs, the advanced models, which can take care of more complex activities, the more complex work that AIs will proactively do. And within AI also, we've seen multiple cycles, right? I mean, from going from very simple to more complex tasks. And as that evolves, the part that gets more complicated, that needs more evolution, is the software stroke services part, not the hardware part as much. At the moment, we are sitting at the hardware part, and hence, the stocks and the sectors that have done so well. So directionally, I agree. The numbers might turn out to be more dramatic than what they show.
That's extremely comforting, Trideep. I think as the start also puts out that when for the last 3 years, we believe that the share of IT services spend has not gone up at all, actually remains stagnant, while we've seen the spend on data centers go up from 5% of total tech spend to going to about 6.5%, right? So which is a large shift in spend if you think about it. And that is what we are living right now, right? We are living through that phase where all the tech spend, all the incremental tech spend of a company is going towards either data centers or towards buying these AI solutions. Great. Now, coming to the next section, which is we all have are living and feeling the impact of AI on our daily lives, right? Almost as you may have seen already, this is the first time that the Google usage has dropped over the last 6 months across the world. But enterprises, and I again refer to almost everyone, every CEO or every expert in the IT services space, both in India and in the West, which is the enterprise challenge is a completely different challenge, right? It is not what we think it to be. So, Sudeep, would love for you to first explain why is the enterprise challenge a different challenge, and why can't an enterprise like let's take an example of a large FMCG company, could be Hindustan Lever, Dabur, Marico, or any of them, or a bank, right? Banks are the most constant users of technology. Why can't they just switch on Gemini, Claude, OpenClaw, or ChatGPT and start?
Yeah, the answer is not very difficult to comprehend, but it is far more difficult once an enterprise thinks about it. Let me elaborate. So we've quickly changed the tack from a B2C to a B2B environment. Now, when you change that from B2C to a B2B environment, you are moving from one person who is at the center of what he's doing, B2C, to B2B, where the organization has lots of sensitive data to deal with, lots of segments that they want to kind of, be careful of, sharing with external parties and let people let people deal with it, or different organizations, the way Deserve organizes the data for its customers would be very different from another wealth outfit who kind of does the same. So while B2C, you are at the helm of affairs, so you can make the change very easily. Data sensitivity, data security, the way data is kept, the way data is maintained, and how, to what extent can it be shared? Are the processes strong enough? Beyond the top 4 or 5, banks, I would say, which is the one of the oldest customers of Indian IT. Very few other sort of the sectors have evolved in a very process-oriented way. Everybody has their own idiosyncrasies. So basically, given all of these factors, what works very seamlessly in the case of B2C doesn't work as much as in B2B. I would draw an example in the case of during the internet boom time frame, when going onto a website, Yahoo and so many different kind of sites made picked up like quickly, but enterprise businesses, when they interacted with each other, that still continued to go from enterprise to enterprise and then change in a very material way with the way they were dealing with overall. So the pace of adoption uh, varies very differently between a B2C and a B2B. Um, B2C is far more quicker. B2B ways to see. To give you a very blunt example, we still have COBOL code running in many of the IBM servers in most of the banks, trust me. And that is a technology which is, if nothing, 30 years old overall, because the risk of making a mistake, the risk of losing customers' data, the risk of, overall a mistake is so big and so large for a bank or an institution or a business that most of them want to be very conservative in this point in time, and that impacts the pace of adoption.
Uh, I think the, a lot of us may not know, and thank you for pointing this out, which is there are some banks, or 70% of global transactions still are handled by mainframes. And mainframes, most of the mainframes use COBOL as their core programming language, right? So why should the change not happen? Or why, the question to ask is, why has the change not yet happened, right? And is AI an accelerant to that change? It is not entirely proven that yet. The other aspect that Tridip, I would love for you to expand on for us is uh, this whole technical debt that Mr. Nandan Nilekani keeps talking about, which is, will AI accelerate the fact that we will need, AI will accelerate the need uh, to move away from technical debt and get updated. And if that is the case, who's going to do it for them?
Yeah. So, contrary to, and this is where when you put out the Gartner forecast, I said that's a product of linear thinking. Things may change materially. So, that curve which showed very linearly software going up might have a few years where, as companies become AI ready, so to speak, they kind of reorient their data to become more AI ready, where companies can do much more with it. Needs a lot more services than what it is. So you have actually go through a lump of services boom before the organization becomes ready to implementation of AI, and that is probably what you are calling as technical debt. Uh, and it will start from, as you put it, that 70% of work is still on mainstream, and that's driven by COBOL. We have a long way to cover. Quite frankly, I mean, I know very little about technical coding, but from whatever little I understand, even if that were to come through, the next 10 years will go in simply kind of getting that done. For sure, you can accelerate, make it maybe about 7 years. But it can't be 1 or 2 months or 1 year or 2 years. So net, the legacy, the legacy, the technical debt you call it, or the legacy, to clean up the legacy to make it more AI ready itself might turn out to be a services opportunity as services companies evolve. But I'm sure someone on the IT services side, on the technical side, will can elaborate on that is a lot more. But what I can say is that on the face of it, the scope is fairly large.
Awesome. On the next slide, Trideep, this is something that is very, very recent. It's over the last few months, where now, all the way from Dario Amodei, CEO and founder of Anthropic, to OpenAI, to Apple Research, they have all come out as, yeah, and very coincidentally, these papers have all come out as we are going enterprise, right? Where hallucination, by the way, in a GPT model is actually a feature, not a bug. But unfortunately, can enterprises have hallucination? Right? Is the $1 trillion question that we really need to ask, right? And Trideep, can you run Edelweiss AMC NAV with hallucination?
I am sure a lot of your viewers would have seen the James Bond movie where the AI system tries to take over the overall world, tries to throw ballistic missiles, and how in manual intervention he stops it. Well, while that might be a dramatic sort of picturization, like most movies do, the theme of this is still true that, and I would put it the way I understand it overall, is that if there are 6 data points needed to get to a particular conclusion, and from data, the AI package has 5 data points, sixth is not there. Then there have been instances where it hallucinates or makes up the 6 data points to conclude and give you the conclusion. And since most people are in a rush to reach to a conclusion, that's what they call it as the hallucination. And what that means is it could lead to erroneous decision making in the context of enterprises. This is, by the way, not true just for enterprises, but for everyone. Even if you are kind of looking for a tennis racket recommendation and you throw at it 5 different rackets to choose from, and it goes about searching and it finds the recent surveys have been because of some new model launches on a particular racket more than others, the chances are that the outcome that you receive in the form of recommendation is more in that rather than giving it a very sort of guarded, equal headed, or level headed consideration to all the possible outcomes. This is what we have to grapple with regards to the recency bias, as we call it, behavioral finance. And particularly enterprises can't afford to simply have this at their behest. Um, NAV might just be a number for people who are not invested, but for people who are invested, NAV means what their net worth is at that point in time. So to answer your question bluntly, clearly not. And I would also say that like you have a lot of sensitive data with regards to your customers. Are you comfortable sharing that data with a AI package where you don't know where that data resides? Maybe it gives you certain sort of analytics out of it, but are you sure that data resides within the country, which I'm sure the country's regulator and the government will evaluate, or it goes somewhere else? Are you sure that when someone asks the question on wealth management customers, that it doesn't commingle this data with that of others? There are many questions which are kind of, which you have kind of alluded to in this slide, and which go on to say that while on a B2C basis, it's very easy to kind of use them to find a tennis racket recommendation. But when enterprises start to think about implementing it for a serious business, there's a lot more clarity which is needed than where it is right now, which included data security, which from a government level point of view, I mean, you know that the US, what Pentagon has done to the Anthropic and what they are planning to do with it. So still the regulator and the central governments have not yet stepped in. So it has to cross a whole lot of hoops before it comes through. My sense is by the time that hoops come happen, you will have a diluted version of this, which will have a lot more services to go along with it, not just one package where you throw in the data and out comes the conclusion.
Uh, Fantastic, Sudeep. We all know your love for tennis. We had to throw in tennis into one of these discussions during the webinar. Uh, I think, yeah, one of the things that we didn't cover, we had it on the slide, is that there is certain percentage of time that everybody spends on coding, right? As Indian IT services industry, some people say that it is 20% of an employee's time. Some people say it's 40%. Whatever that number is, let's assume that the requirement of that comes down a lot, right? And I think there is no debate whether it is, uh, you know, whether do we need the same number of people to code than earlier. And Tridip, one of the things that I would again urge you to cover is that this is not the first tool made available for coders, right? In the last 25 years, there have been multiple tools that have come up, and for some reason, I for example, I'm very familiar with GitHub, but I'm sure there have been many more coding tools that came up over the last 20 years, which actually reduce the time to code. In fact, one of the things that hit me was, I'm sure 25 years ago, a software engineer's 100% time would go into coding. Right? Today, that number is between 20 and 40, depending on where you work and which level you are, which means that something helped to bring this from 100 to 40 or 20, right? What were some of those interesting changes that you saw through this?
So I would actually take you back to the time when computers were not mainstream. This I'm talking about 1990s. So I don't know what you were doing then, but pretty old in the day. Um, and I want to bring to a level which I do, which is equity research at that point in time. Equity research, building models, getting to P multiples of stocks was a task because people used to use calculators. And the model that you sort of very nicely build on Excel and it happens within a matter of 10 minutes used to be actually on a piece of paper where people would write down the numbers and forecast and do the same. And we heard, and at that time I was new, we heard it from our seniors that, well, your life is easy, right? You've got an Excel file, you just key the data in, and the output comes about. Um, Overall, we had to spend tons of time to actually writing that data out, do the mathematical calculation to be sure that we are doing the calculation right. So from the time when PCs were not mainstream to the time that PCs were mainstream, clearly it was an innovation which saved a lot of time. The same thing with coding. Earlier, a software engineer would code 70, 80, or maybe a meaningful part of his time on coding. Now that time has come down to, as you said, about 20 odd percent. He has a lot more things to do. But have the number of IT people gone down when during pre-PC era and after PC era? The answer is no. They've actually gone up and many fold. You had an entire kind of industry which is laptop and various evolution which came about, which is goes back to the original point that you made, and very succinctly, very subtly. But that's probably the lesson for all of us, that we overestimate what can happen in the near term and underestimate what can happen in the long term. So the new markets that can open up, which included laptop, which included desktop, now mobile computing, and all of this weren't even thought about at that time when PCs came through. So the number of people actually went up. I would go on to say that I am yet to see an innovation globally over the last 100, 200, 300 years, which has not led to kind of, a increase of work done rather than otherwise. The classic paradox that we keep talking about is, if you do have a car which consumes less fuel, then ideally the oil prices should have been far lower, because over the last 20, 30, 40 years, we have really spent good amount of time in building efficiency in engine. The fact it is not. In fact, markets have expanded. It goes on to show that net, there are other things that so there is efficiency gain, there is productivity gain, and we use that to do something even more meaningful, which needs more services than otherwise.
Fantastic. The car example is very pertinent, which brings us to the next section, right? Which is what we call the Jevons paradox, and I think this is something that all of us have seen it play out, right? And they've touched upon it, which is you know does more efficient does efficiency lead to proliferation or to scarcity, right? And time again, efficiency has led to proliferation, right? Whether you look at steam engine, when steam engine came, it was the most efficient use of coal, and people thought coal industry will collapse. And you know what happened. Same with ERP systems. It didn't reduce IT staff. It created the IT services industry. Cloud didn't reduce software engineers. Demand exploded. Similarly, what will AI do? As Trideep very nicely put it, there is no innovation that we have gone through which has not grown the whole pie, right? Some obviously there'll be rearrangement within the pie, no denying that, but the whole pie ends up growing. And I think the other aspect that we do want to call out is for all of us is this takes time, right? E-commerce penetration in the has been around for 25 years. E-commerce penetration is still 16% in the US, right? I think the penetration of cloud, again, been around for 20 years, is only 27 to 28%. So these things take time, and nothing comes to an end yesterday or today. But interestingly, Trideep, this is a very bold prediction by the World Economic Forum with ICRAIR, which is AI will actually create more jobs than it destroys, and it looks quite brave to make that kind of a prediction. But any thoughts on this, Trideep?
Absolutely. Directionally, I would be supportive of what they are thinking, and the reason why most people are scared there than kind of aesthetic about that is because we don't know what those markets are, whereas we know that what we are doing will not be the ones that we will do in about 3, 4, 5 years time. So obviously the risk is real. The opportunity is not yet in front of you. So it's only human that people get a little scared, that and they sort of believe in the more doomsday rather than the positivity that comes out of it. But the slide brings about very clearly that every time there has one part came about. So to take an example of this ERP thing, before the ERP packages came through, all of these, what a package does used to be done by IT services people. So the question really at that point in time was that, well, it will now be done by a software. So what will IT services do? And hence, bust. But what happened is, what they figured out is, for you to implement all of these packages, you need more people than what they were earlier. To make the organizations, the angle that we discussed in the previous section, to make the packages speak to individual organizations and their specific needs, you needed more people. Now, these couldn't be thought about at the inception, but turned out to be bigger opportunities. So, hence, in that context, I can see why the World Economic Forum has said what it has said, and I would directionally agree with that.
I think fantastic point, Sudeep, which is we are extremely scared, and rightly so, because we know what could not exist, but we are extremely uncertain because we don't know what will come about. And I think that is very beautifully put. Uh, the known of the demise seems very obvious, but the proliferation of the future is from the unknown, which becomes impossible to comprehend for the human brain. Uh, Last slide, which I think we want to end with, which is never look away from the data that is real. Sometimes the narrative and the hyperbole around the narrative can distract us as investors and as people who are invested in the market. But this was really stunning for me, right? This was present. Citadel Securities, one of the largest securities firm in the US, compiled the job postings. So Indeed is equivalent of Naukri, if for a better comparison. Indeed in the US has this is the job. The blue line that you see is a software engineer's job posting, right? So when I say job posting, this is obviously what companies are posting on Indeed, and as you can see, this is near a 2-year high, right? And on the other hand, overall Indeed job postings have fallen, as you can see in the black line, while the number of job postings for software has gone up. This was truly I mean, when I saw this chart, I was quite stunned because the narrative on the in the markets is extremely different. Tridib, does this surprise you? Does this chart surprise you?
This is what makes me do tap dance to work, as Warren Buffett puts it. That there is this convenient narrative, there is this consensus, there is this mass view. But when you actually do the research, you find out that actual data is different from what it is. This is what creates mispricing in the markets. In very simply put, Sushmit, in last 25 years, this is the really crux of research that all of us try to get to. That what is the insight? What is that mispricing that sort of, that brings about? Of course, I'm talking about in a different industry, and I'm talking about how we ultimately, because all your clients are listening, so it's about investing. This is what we thrive on, Smith. This is what we try and spend a whole bunch of time doing that, and you spend a good amount of time doing that as part of your career, where we try to find what is the mispricing. And clearly, while there are, you started off with that doomsday paper cuttings, and as you say, this is the last slide where kind of job postings are at a 2-year high. The reality will be materially different from what the mass narrative is all about. Ladies and gentlemen, for everyone who is listening, this is the insight, which is the crux of research that we do. And hence, we put together a bunch of stocks where such insights are encapsulated. And as the view becomes more, as the true view truly comes out, the mispricing gets corrected. And that's the recipe for creating alpha in markets, like this chart, which actually is a fascinating chart, Sushmit, and the right one to end the conversation with, and also shows that maybe there is mispricing.
Awesome. Thank you so much, Sudeep. We can go on, but I'm going to be mindful of your time and also keep a few minutes so that we can answer some of the questions. So I'm going to do the easy job, Sudeep, which is to select the question and let you do the tough job of answering them. Uh, so the first question is, you know, will the share price reaction to every launch of an AI module continue, and how should investors think of that or react to it or behave to that?
I mean, I'm going to go give it a very old school answer to this. And this is in the social media era where every small move gets amplified and talked about, and we desperately, even though there is none, find out long-term implications of a random move which happens in the near term. And we do all this because we are dealing with stock markets which trade every day. and you we trade every hour, every minute, and you get prices, and you get and hence you spend time on it. Whereas if I were to shut down the markets for a couple of months, you will probably not even think about it and see that, well, like many other trends in the past, this will also evolve. So my sense is Anthropic is there to raise money from markets. So clearly, when we go out to raise money, we talk great about ourselves. The use cases are still theory than practice. And we discussed over the last hour, how enterprise adoption takes a lot of time and is far more easier said than done. Um, but at the same time, for them to maximize the dollar that they can raise, they have to create as much social media value, as much value in front of market altogether. They are doing their job. We have to do our own job to maintain sensibility and look at long term. What we discussed over the last 1 year is that many times in the last 25 years, these trends have come and gone. The industries have survived. The IT services industries have survived. Even though every time, if you actually plot the share prices, you will see the share prices corrected meaningfully, but it came back over a period of time. I'm not making a prediction for IT services in the next 3 months or 6 months, but directionally, I would certainly say that stay away from short termism. A lot of this is sensationalism, pointing to random data points, which kind of ultimately, from the medium term standpoint, have limited bearing. Um, Consult a sort of a advisor like that of Deserve to see what asset allocation one should actually pay attention to, and stick to that through the times which are kind of tough at the moment from certain sectors than that of others. The wealth transfer that happens in stock markets is always from the active to the patient. So I would advise patience.
Awesome. Very interesting, Pradeep. Remind me of what Mr. Ben Graham said, which is in the short term, markets are a voting machine. In the long term, they're a weighing machine. Today, the voting is extremely polarized thanks to social media, and that makes it tougher and tougher to keep the weighing machine hat on. Last question before we end, Pradeep. Uh, do we need to think differently between large cap, mid cap, and small cap IT companies with this wave of AI?
Yeah, I think we there is a very sensible question to that. We have got to go a lot more company specific rather than an industry view. A very simple rudimentary way to think about this is the larger the company, the larger is the legacy component, which will deflate, and then the new services will come about. So larger is the task force to do that. On the other side, they are the bigger vendors. They have the wherewithal to spend on it. They can buy a couple of companies and solve that. As I told you, a few different nuances. Basically, what I'm looking to say is we've got to look at individual companies' plans to inculcate or incorporate AI in their service offerings and make that transition being faster than that of others. The companies that can do faster than that of others will be the winners, like in many other businesses. Whether there's a large cap, mid cap, or small cap is secondary in question. The dice is slightly loaded in favor of mid and small caps because they have a smaller base that they can sort of pivot around as opposed to larger companies. But you never know. Elephants can dance.
Great. Thank you so much. This has been fascinating today. Learned so much, and that's the other reason we tap dance to work, right? Which is we learn something every day. I mean, some sector is getting innovated or disrupted, or and markets and fund management and having a portfolio is no better way than to be updated about what's happening in the world. Uh, Thank you also, Pradeep, for calming the nerves. I think a lot of people, a lot of our clients that also work in IT companies, IT services, they also are nervous not only about their wealth but also about the future of their employment. And I think coming from an expert like you who has seen 25 years of this cycle, it's very very clear that we probably are preempting writing the tombstone for our Indian IT services. And lastly, while you have not, uh, while you're not predicting any turnaround in IT stocks, but my takeaway from your talk is is that it's not a very bad time to be invested or to start thinking about this sector as well. Great. Thank you so much, everyone. We had about nearly 270 people throughout the session. Thank you so much. Thank you, Trideep. Have a great weekend, and may India win the World Cup. Thank you. Bye.
Well said.
Uh,
Happy investing. And thanks to Deserve for giving us an audience. It was fantastic discussing with you, Shishma.
Bye.